Friday, August 16th, 2024, Monaco 64, home of alternative economics and contrarian views. Good morning, Clive. Nice to see you again.
Hello, Mario. Good morning.
So we've been corresponding this week, and you pointed out to me that there's a lot of activity, takeover activity in the mining sector. And it's interesting because gold is right in, well, very near an all-time high. I know silver is still under pressure, but when you look at the GDX and GDXJ, we're still massively undervalued compared to 2 years ago, and especially 2011. So maybe you could tell us about what's going on and the repercussions and what it means to the mining sector and to gold and silver.
So about a year ago, we were looking at a gold price somewhere in the region of 1,600 to 2,000. And right now we're looking at a gold price just above 2,400. So the gold price has risen quite substantially. What does that mean for gold mining companies? It means if they had 10,000 ounces of reserves last year, the number of reserves of ounces in the ground they'll have is perhaps double. It's going to be 20,000. Why is it 20,000? Because reserves which they had, but which weren't economically viable, have now become economically viable because perhaps it cost 1,600 to get it out of the ground. And with the gold price at 1,600, nobody's going to invest in the machinery and the equipment to get it out. But when the price of gold is 2,400, that gold in the ground becomes very attractive. So across the board, all mining companies, gold mining companies in particular, have become more valuable. They've become bigger, and they have in the ground more resources than they had a year or two ago. What does that make them? It makes a lot of these companies attractive targets for those who've got the money, or those who are larger companies who can use their shares to acquire properties. And what I'm going to do today is just show you a few slides of various acquisitions which are going on very, very quickly. And then I'm going to tell you how you could potentially identify the next targets. I'm not going to actually name the targets, but it's I've done most of the work for you. It's a very, very easy next step for those who are interested to try and find some potential targets of what's going on in the gold mining industry. So let's just have a look. If I can share my screen here, Mario, and I'm going to go to Google Chrome.
So targets.
Yes, go ahead.
When you mean targets, they're targets of takeover by the bigger companies.
Yes, or smaller companies might just merge together.
Yeah.
The obvious way, obvious thing which is going to happen is large companies which have lots of cash and low debt would be buying smaller companies which have now got much increased reserves, but they have too much debt and therefore they can't expand the way they'd like to. So the larger company can provide the resources for them to expand. But just looking at a few deals which have gone on recently, this headline says Barrick CEO says gold giant is eyeing opportunities in Canada. Go to the next one. This is another gold company, Goldfields. Goldfields is to buy gold miner Osisko. That's a done deal for $1.7 billion in cash. The next one says earnings called Franco-Nevada reports growth amid acquisitions. And if you go to the Franco-Nevada website and look at their slideshow, you will see that over the years, they've constantly acquired more and more gold mining companies, and they consistently increase their reserves through acquisitions. And just to mention a small point, Franco-Nevada is completely debt-free, It hasn't got a penny of debt. It's got $1.4 billion in cash. Of course, it has borrowing power, and of course, it's got shares which could be used as currency if it wants to buy something. So that's potentially an acquirer.
That's a royalty or stream.
That's right.
Streaming company.
So but they might well acquire the royalty stream for other companies, which would be cash flowing into the other companies and good for shareholders.
I see. So they also own whole mines outright, apart from the companies.
I saw on the website that they're into acquisitions, but it didn't say. I mean, I know they've traditionally been a royalty company. It didn't say whether those acquisitions would be actual companies or the royalty streams from other companies, which obviously gives them the companies which are selling those royalty streams would be giving them a lot of cash for expansion. Here's another one. Canada's Wheaton Precious Metals has a 40% production growth. It doesn't say anything about acquisitions there, but obviously with the rising gold price, you could increase your production. Alamos Gold announces closing of Argonaut Gold acquisition. That was in July. Royal Gold announces new acquisitions, or reports strong financials, new acquisitions. Agnico Gold has just increased its stake in gold mines. That was in Maple Gold Mines. That was in June. Newmont, that's last year, actually, it was late last year. Newmont spent $16.8 billion on Newcrest mining. So Newmont are probably not going to be an acquirer at the moment. They're probably still digesting that particular acquisition. And of course, that acquisition did put them into debt a little bit more. They're not deeply in debt. Newmont is not in a problem situation. It's about 20% net debt. So that's not serious, but they probably don't want to increase that. But even the large majors might be in the market for mergers and acquisitions. And these could include companies like Rio, Glencore, Anglo American, BHP. I mean, I'm not saying that these companies would be targets, but they could well be in the market to acquire gold mines. So which companies are likely to be the targets? In my view, if you're buying another gold mining company, you're going to be looking for something with gold mining properties with resources near to where your company is. Why is that? Because if the fields of the other gold mining of your company, your target company, are quite close to yours, it makes moving equipment around, it makes moving the engineers around, it makes moving the staff around according to what's needed and where. Even for management, it's a lot easier for management to visit two gold mines which are only a few hundred miles apart, as opposed to two gold mines which are thousands of miles apart. So we've looked through some of the. We'll in a second look through some of the big companies, and they would be perhaps the acquirers. But what would they acquire? Well, that's the next step that your listeners or readers can do, is find out what companies are have land near to these big companies. I'm not going to name them because I don't want to get into the speculation of what's going to be a target and what's not. But to find that out, I use ChatGPT. I just asked the question, for example, what companies have gold fields near to the gold fields of Newmont, or what gold, and so on.
Or you could also go on bigger companies' websites and look at where their properties are. And a lot of times they give you like a map, and they tell you what other companies are near there. And maybe also even look at the smaller companies' websites. And a lot of times they point out where they're exploring for gold and silver or gold. And they show you, while 2 miles away, there's a Newmont property. Or you can ask ChatGPT. And the other thing I would say, Clive, we're not telling people here to go and buy miners. We're just giving them our opinion that, yeah, miners are very much undervalued. And why do you think that is, Clive? I've got my ideas about it.
Well, as far as the share prices are concerned, people have become rather disillusioned after 10 or 15 years of poor share price performance, when the gold price, for the most part, wasn't doing much over that period, but the stock market was soaring. So what has happened? People have been saying, oh, I want to buy NVIDIA, or I want to buy the Bitcoin ETF, or whatever it happens to be, the latest hot fad. And they say, what can I sell? Oh, I've got this gold mining company. It's done nothing for 5 years. They sell it, and they buy into whatever they think is hot. But of course, gold mining stocks are starting to become hot. They have already started moving, albeit that they are way, way below where they were. And I think you're going to show us that in a few minutes,
Yeah,
Mario.
I've got this chart here of the GDX, and the high in 2020 was 42.74, and we're still at 37.29. And if you go back further, in 2011, we got up to 65.80. That's when gold went up to 1900, and now we're almost at 2,500. So, yeah, this is value here, I would say. And I know the mining sector is very cyclical, but if you want to buy something that is cheap, in my opinion, this would be it. And also the GDXJ, which is the junior miners. Look at that, Clive. Back in 2010, 2011, we got up to what's the high, like 170, and we're still at 45. So I'll let you continue.
Yeah. So another thing which I did, I went to look at 10 to 12 of the larger gold mining companies to see how much debt they've got, how much cash they've got, and therefore how much ability they've got to buy other things. What came across to me was the vast majority of them have been reducing their debt significantly over the last few years, and across the board, it's pretty low. And quite a few of them have no debt at all. So just to illustrate that, American Barrick, their net debt to equity. Now, net debt is you take the total debt, knock off the cash. So that's net debt. Net debt to equity is only 2%. That's nothing. Newmont Mining, who made that large acquisition in December, November last year, their net debt to equity is 20%. That is still pretty low by industry, by any standard, compared with many companies. Freeport-McMoRan, it's 14.5. Franco-Nevada, it's Franco-Nevada has no debt at all. They've got 1.4 billion in cash, so they've got a lot of facility. Kinross is 23.8. Wheaton has no debt at all. That's Wheaton Gold Mining, Wheaton Gold Corp. So zero debt, $540 million in cash there. Alamos Gold, no debt, 377 million in cash. Royal Gold does have some debt, but it's got more cash than its debt. Agnico Gold is 4.6%. That's nothing. B2 Gold has got no debt at all and 466 million in cash. And if I keep going, there's quite a few more I could read out there, but let's say Goldfields, they've got 12.7% debt, net debt to cash, debt to equity. So across the board, they've all got buying power, one, through their cash, two, through increasing their debt, and three, by issuing shares to buy other companies. All of that makes me think that with the very much increased value of the small gold mining companies, all of these will be looking around for companies near to their existing properties, and potentially some of them will be targets. I did a little bit of work, and I'm not going to name the name, but I can tell you that one very large company, it's one of the majors, does stand out as a potential candidate for a merger because that particular one has slightly more, well, above average debt. It's got too much debt to make new acquisitions, and it probably has enough debt that it doesn't really want to be expanding on those reserves, which have become profitable now. So I won't name it, but perhaps people could look around and find themselves some other targets, particularly the small mining companies. And now, Mario, do you think the way to play that would be to buy the companies or to buy the GDX, which is the ETF tracking the majors, or the GDXJ, which is the ETF tracking the gold mining juniors? What do you think, Mario?
I would say the GDXJ, because a lot of those junior companies they're not producing, they're exploration companies. And that's what the bigger companies are going to focus on, I would say, Clive.
I think so too, and also if you look at the chart of GDXJ, which is the gold mining's ETF junior companies, you'll find that the price today is way below where it was a few years ago. Yet the gold price is sitting at a record level. There seems to be a bit of a disconnect there.
Yeah, I mean, look at this. I think the bull market in gold, or it's really a bear market in fiat currencies. Look at this. I mean, this is a quarterly chart going back to the early 70s. It looks explosive to me, but there seems to be no excitement yet. I wanted to ask you, Clive, because you did a really good job of looking at that net debt to equity. Can you give us an example of a big company that's not in mining, what their net debt is? For example, maybe Nvidia or Microsoft and some other companies.
Yes, I can do that very quickly. If you just bear with me, let's. Well, obviously, companies like Microsoft and Nvidia are probably fairly cash rich. We should perhaps look at something a little bit more mundane, like I don't know. Let's try IBM and see what that has as a debt. I'm just going to bring that up on my screen here. You won't see it, but I'll just look at the figure. Um, Oh, I need to go. Yeah, maybe. And I have no idea what the result is going to show here, but it'll give you an idea. But
Yeah,
usually companies are more like, I can tell you companies are more like 30 plus percent typically.
yeah,
And I could just bring that to financial health. I'm looking at the financial health of IBM. Okay, so IBM. IBM's net debt to equity ratio is 174%.
wow.
Okay. Now that doesn't mean to say they're insolvent or anything, nothing like that. But it does it shows you that they have a very in that particular case a very high level of debt compared with their equity, whereas most of the gold mining companies, in fact, almost every one bar one, had a net debt to the ratio of below 30%, and
Yeah,
many of them were below 10%. So here we looked at a random commercial company, IBM. I didn't know I was going to see 174%, but I'm absolutely astonished to see it says IBM's net debt to equity ratio 174% is considered high. IBM's debt to equity ratio has reduced from 410% to 231% over the last 5 years.
Hmm.
But their debt is what their interest on their debt is well covered by earnings. That's
Yeah.
what it said. But that's just an illustration. As I say, most companies have got net debt to equity ratios much higher than ones I saw in the gold mining sector. It really surprised me when I saw how little debt the sector has got.
Well, the other thing I would add is they're sitting on money, a lot of,
And
if you can
yeah,
say old money. And the other thing people might be wondering if you get the majors buying the smaller properties and developing them, won't that increase the supply of gold? Won't that drive the price lower? I don't think right away because a lot of these projects will take a few years to get running. And from what I read and what I'm reading here, Clive, in this book, the Great Depression, a diary of Benjamin Roth, is that when there during the Great Depression, when a lot of companies were going under, the banks were closing down. There was a rush to find gold, and the mining companies actually did really well, and gold mining production increased. But despite that, the price of gold kept going up internationally. So, and
I
I
think it's
think,
fair to say that the vast majority of people I speak to have zero gold and zero interest in it at the moment. But as the price starts to rise, I think that will start to change. I've already seen a number of large investment institutions, major banks, move gold from their not interested at all category to their most preferred category. And I think that that trend in investment management companies putting gold into their investment allocation will increase. Right now, probably where are they? Probably at 2 or 3% for those who've done it. Those who haven't done it are still at zero. And
yeah,
that will be the majority.
talking about net debt and debt in general, Clive, I want to, I don't know if you've seen this. I'm going to share it here. It's from Visual Capitalist. So this is global debt has reached 315 trillion. And it was in 2016, global debt was at 221 trillion. So it's gone up by like 50% almost. Um, and the blue line is debt to GDP. Yes, it's come down. but it's come down because the economy's closed down for lockdown and the debt was increased, and that's why it jumped to 360. But
Yeah,
it's
a lot of people increased their savings during the COVID lockdown because they were no longer spending money on transport, holidays,
yeah.
eating out, drinks, pubs, that sort of entertainment, that sort of thing.
Yeah, but what I was going to say as well, the economies were closed down, so GDP was actually negative, and that's why the debt to GDP after the economy reopened has come down, but it's still at 333% of GDP, which is a lot, significantly higher than 320. Um,
That figure will head upwards now because people have largely spent this money they saved in the COVID pandemic.
yeah, I agree.
So they're going to start going into debt now.
And I think the economies are slowing down. What do you think? Yesterday we had a number in the U.S. retail sales. Everyone was going on about it that it was strong and that it shows that the U.S. is going to have a soft landing. But I looked at some articles like Zero Hedge. They noted that the previous month retail sales they revised it down quite a bit. So of course the one that came out yesterday is going to look a bit better, and a lot of the other statistics are showing that the consumer is not really doing much. So what do you say about that, Clive? Do you really think we're going to have a soft landing?
Well, I think anything I say, there are going to be some people who are going to strongly disagree because we're living in two worlds here. On the one hand, we have a huge army of impoverished people who can't get jobs or don't want jobs and are living hand to mouth and probably increasing their credit card debt. And on the other side, we have some official statistics showing that there's plenty of jobs, apparently, showing that wages are rising and that the GDP is going up. So, which one's the truth? It's very hard to know. I think we're getting more and more into a divided economy of those who are hardworking and have two or three jobs perhaps to survive, and those who just give it up and said it's not worth the trouble. So are we in a recession already, or is the economy booming? That's that's an open question. But if you look at the official numbers, it's certainly not a recession yet, and there's no sign of a recession yet. But that could come fairly quickly.
Yeah, one thing that bothers me about the GDP number is that they add government spending to it. And if you look at the deficits that the US and even the UK are running, that really gooses up GDP numbers. And I think they've done a lot to try to keep the CPI or inflation numbers down. So, yeah, and I don't think we'd be having here in the UK problems with the public finances if the economy is doing so well. Tax receipts would be going up. We wouldn't have people unhappy with their lot. And we've seen that in the last 2 weeks here in the UK. I won't go too much into that. I think it's more than just
Yeah.
the immigration question. It's the fact that the rest of outside the M25 bubble, which is the the orbital motorway or highway around London, things aren't that great. I've seen videos in the last 2 years of seaside towns, resorts, all boarded up, all the shops. So yeah, I'm not too sure
Yeah,
either,
well,
Clive.
that's absolutely correct. I mean, I I haven't been to the UK now for a couple of years. Last time I was there were already the signs of things closing down, and I'm sure it's got worse since then. So, as I say, it depends what you see with your eyes. It depends who you talk to. It depends who you are on your opinion as to whether we're in a recession or not. But GDP officially apparently is still rising.
Yeah. And well, yesterday we had, I think it was yesterday, we had UK GDP and it came out at zero point 0.6.
It's not much.
No, and there's a headline in the Telegraph saying, "Oh, UK is doing the best country of the G7," but I remember when GDP was 2.5, three, sometimes 4%. So it's all relative. And talking about the economy, Clive, there's a lot of people who feel that the uh, the kind of mini crash, well, it was kind of a Black Monday for Tokyo, that what we're seeing now is just a rebound, you know, a sucker's rally, and that things are going to come back down. And I want to show you this chart here from someone I follow on X. He put some interesting charts up, and he's comparing 2008 to 2024. So I'll enlarge it here and see what you think. So he thinks we're like here, and that we could see a massive, I mean, kind of a correction coming up towards the end of this year. Like he sees the Dow going back down to like 37,500. But what he sees here in the next couple of years is pretty vicious. Is that the kind of thinking you have as well for the stock market, or are you more balanced?
Stocks do have their bad moments. I mean, crashes are part of what you're going to expect if you own stocks for any period of time, like 10 years. You're going to have some mini crashes and you're going to have at least one large crash. It's just the way the stock market goes. So to predict a crash, at every moment in the 50 years I've been investing, I've seen crashes being predicted all the time, non-stop by someone. And some of those people were right. I didn't see any of them get it right twice in a row. But obviously we've got people here predicting a crash and they might be right. Excuse me. I'm not going to predict a crash, but I do think it's a real possibility. But I don't sell my shares ahead of that because I think what will come out of if we do have a crash, I think we have the Fed put, and it's not just the Fed put, it's a global put of all the central banks, that if we have a crash, it'll be foretelling a recession. That will push the central banks into printing mode, and they'll start printing like mad. And long before the recession is over, maybe before it's even started, the stock markets will be recovering because of all the cash being thrown into the stock market. Does it mean we'll get back to where we are today because we are somewhat overvalued? Maybe not, but I don't think it's enough for me to gamble that I should go out of stocks into the worst asset on the planet, which is cash.
Oh yeah, cash. No, I don't mean cash, but do you think it's? I think it's good to have a physical gold and silver, because
uh,
if we do have
I,
a crash,
I've been increasing my gold and silver exposure constantly, non-stop, every month, including this month, for since before we were talking, Mario,
yeah.
because I do see this as a way of hedging my risks against a stock market crash. I still have a lot more in stocks than I have in gold and silver, but the gold and silver is certainly 2 or 3 times what the level it was a couple of years ago.
And there are some people who think the central banks might not this time come back with QE and throw loads of funny money at the markets, at the economy. But I saw someone as well predicting that this time around, when there is a crisis, if they will, like the Fed will increase its balance sheet. I'm not sure if it's 20 trillion. I think it's around 7 now. But they said by 20 trillion. I mean, that would be, I would see gold flying if they did that. One of the reasons why I think that might happen is because the Federal Reserve, under law, I think it was 1978, the Humphrey-Hawkins Act, gave the Fed the mandates to keep full employment and stable prices. So if we do have a massive crash and things deflate massively, I guess it would be part of their mission to come out again and inflate. What do you think, Clive?
I'm absolutely certain that the central banks will be forced. They will either do it voluntarily, That would be the wise move because you don't want to be the enemy of your masters, the government. That would be the wise move to inflate when things start to turn bad. But if they don't, they will be forced to do so. It's all very well saying the Federal Reserve and the Bank of England and others and the ECB are all independent. But when the need happens, laws can get passed to force them to do so. We've seen that happen in the past where, for example, the US government in 1934 basically passed a law forcing the Federal Reserve to buy government bonds. You know, it wasn't actually something they wanted to do necessarily. Maybe they did, maybe they didn't, but they were literally forced to. It was the law was not worded "you must do it." It was worded "the Federal Reserve is hereby authorized to buy," and then it had a figure 20 billion of bonds. But reading between the lines, that was do it or else. So yes, if we have a crash, they will be in the market buying bonds and printing currency to buy them with.
Yeah, I think the Fed in the 30s, from what I'm reading here in this diary book, even before FDR, Hoover, the Hoover administration already got the Fed to buy government bonds. I think it was, like you said, in 34 or 35 that they passed this law retroactively because the Fed was actually acting unconstitutionally under the Hoover administration. So that's pretty interesting. And when push comes to shove, Clive, the central banks will. They're not really independent in a crisis. If you remember well, 3 years ago, under the lockdown, yeah, that was the excuse. Central banks have to come out and buy all this debt that the government is issuing in order to help the public. They did the same thing in 08, 09. And let's wrap up, Clive, and look at this chart that I was looking at yesterday because it's almost 2 weeks since the Black Monday in Tokyo. And the major reason for this is that Japan is having a tough time unwinding their really loose monetary policy that really kicked off massively in 2013 with Abenomics. I don't know if you remember that. And of course, the Japanese yen has been a currency that has been borrowed by the whole world, the yen carry trade, to buy higher yielding assets. So as long as the yen stays weak, like it has been here since, let's say, the beginning of 2023, and that's the dollar going up, things are fine in the markets because it means people are borrowing yen and their loans are getting cheaper. But when we saw this happening here, this drop, which culminated with a huge drop here last week, look at the VIX index. It went up massively. Yes, it has corrected. The dollar has rebounded. The yen has weakened. But we are at a critical juncture here. Do you think Japan and the world are out of the woods from this carry trade fiasco?
Japan is a long way from sound money at the moment, but it's going in the right direction by starting to increase its rates. It recently increased them from 0.1% to a range of to 0.25%. The previous rate was 0 to 0.1, and the rate now is 0.25. And the interbank rate for yen is 0.45. So that's risen substantially as well from close to 0. Now, what that's done as they've raised the interest rates, starting because the yen is in the direction of sound money, and it's only just, by the way, it's not really going to go that way, but because it's less bad than it was, people are starting to buy back or pay back their yen borrowings, and that to do that they're selling their dollars or other currencies. So how far will that go? I don't know. But what this has done is caused a bit of a crash in the stock market of Japanese equities, because with a higher yen, it makes exporting harder for the Japanese companies, and therefore the share prices are going lower on the expectation of lower foreign sales. Do I think it's going to continue? I think it probably will, which means we could be in line for a second phase down in the stock markets.
Yeah,
Was
and
that your question? What was that? Was that your
yeah,
question,
that,
Barry?
that was
I
my
think.
question. Yeah, it was. And the other thing as well that people need to keep in mind is if the yen continues to strengthen, if the Bank of Japan keeps raising rates, um, they will buy back their yen loans. They'll cover their loans. But when they do that, they have to sell also their riskier assets. And that's why it creates the volatility. And I would also point out that it seems like all this yen fiasco and Bank of Japan raising rates is had its first victim in the Prime Minister of Japan. He's going to resign from a leader of his party, so they're going to have a new prime minister. And I saw an article that there's political problems in Japan as well, just like here in the West. And one of the reasons they say is because of the cost of living. And we're told that Japan has deflation problems. And when they talk about deflation, the mainstream, they mean prices going down. So it doesn't make sense that people are hard up in Japan, the general public, because of the rising cost of living. And there's a deflation problem. But I think what they mean by deflation is that Japan has yeah, like their unsound monetary policy, the other side of the coin is massive debts, and they can't. And I think, Clive, I'm not sure the Bank of Japan will be able to raise rates that much further unless the Fed starts cutting aggressively. Then I think things could calm down. But I think this whole year, people, ever since late last year, people have been expecting loads of rate cuts by the Fed. That went out the window a few months ago, but now they're starting to talk again. And I'm not too sure we're going to see too many rate cuts by the Fed. And I think that's also key.
Before we wind up, Mario, I'd like to show your users something. I've been investing in euros, but it's not the kind of euros you think. These are
Hmm.
10 euro pieces. They're from countries issued by countries like Belgium, France, Germany. There's a whole pile of them here. They're all 10 euros. They're solid silver. And I paid a little bit more than 10 euros each. So I have a sort of put, if the worst comes to the worst, I can presumably go to the ECB and have them cashed in at 10 euros each, which I'm not going to do, of course.
How is that?
Uh,
How many ounces? Is that 1 ounce or?
Oh no, I haven't weighed it yet, but it's probably about a quarter of an ounce or
Oh, I
maybe
see.
a little bit more. It's very light. They're very light coins. They look. It's nothing like an ounce. It's
Who
at best half an ounce.
who mints them, Clive?
Well, the names of the countries are on them. This one says Deutschland.
Yeah.
This one says Autriche. This one says Netherlands. There's even one minted by the UK. Would you believe it? At least that's what it says. And they're official tender because they got the currency number on them, the 10 euros.
Hmm.
Yeah, Netherlands. This one says Belgium,
Yeah.
France. Yeah, so basic European countries.
Yeah.
I think that was Greece. Uh, but you can only get your hands on them through a coin dealer. But then I don't think the silver. I'm guessing the silver in this is worth a little bit more than 10 euros. That's what I
Yeah.
think.
So I just want to show you something I have here as well. Uh, and I'm going to share this page first. Uh, the Dirty Man Safe, which I'm affiliated with. I got these coins from them. They're not real silver or gold. You can see here. It's a Dirty Man Safe. Uh, and they will send you one of these, or it's not gold, but it's a bit of fun. So if you buy a Dirty Man Safe and it says Dirty Man Safe, pass along to your most trusted friend so they can find out about Dirty Man Safe. And if people want to keep their coins and even crypto wallets safe, yeah, think about buying a Dirty Man Safe. There's a link below in the description. You get 10% off and you'll get one of these coins. And again, they're not gold and silver, but they're just for fun. So, Clive, um, any plans for the weekend for you? Or
Well, I probably have to dig up the garden to plant my dirty man safe, Mario. I just hope I don't forget where I put it.
yeah, great. And so for the
But
view,
gardening's the thing.
yeah, for the viewers, then if you want to connect with Clive, you can do it through LinkedIn, Clive Thompson. He'll try to answer as many questions as possible. And yeah, make sure you also subscribe to my channel if you haven't yet. And Clive, I wish you a great weekend and the viewers as well.
Thank you, Mario. Good weekend to all. Bye bye.
Bye.